Mortgage insurance is a concept that a lot of people have spoken to me about over the years. I was selling retail and residential real estate for 17 years, and this is one of the first questions that new home buyers would come to me and speak to me about. And insurance is when a buyer is putting down less than 20% of the purchase price. So for instance, if you're buying a property for $500,000, 20% is $100,000. And now this is very difficult for some first-time home buyers, unless maybe they've been really adept at saving, or maybe they have gifts or wedding gifts or a gift from mother or father. It's very difficult to come up with 20% of a purchase price on the first time down. So what the government has done to aid this is they have insurance. They have CMHC, Genworth, and Canada Guarantee. And there's three insurers that pretty much backstop the banks. So it's a sliding scale on how much insurance you're gonna pay. You can pay upwards of 3%, and the scale slides down as you put up more percentage. So if you put up 10%, the fee is less, and if you put up 15%, it's less still. Now the 3% fee would be based on the total of the purchase price. So for instance, if you bought a $500,000 property and you put down 5%, you'd be paying 3% on the balance, on the $475. So just under $15,000 would be your premium that you would have to pay. Now this premium is not charged directly to you that at the time of closing. It's added to the balance of the mortgage. So this makes it easier for financing purposes, that you don't have to come up with 5% plus the CMHC or Genworth or Canada Guarantee premium. Now the reason they have this insurance is to protect the banks. The bank is lending you money, and in the event that you default, the insurer steps in, they pay the bank, and then they recover the funds from you in the event that the bank is unable to recover the funds or anything of that nature. So even though you're paying for the insurance, it's really for the protection of the financial institution. The default rate in Canada is extremely low. It's under 2%. So it's not something that traditionally happens, but when it happens, the government has mandated these backstops in place to make sure that the consumer and the bank are protected and the funds are recoverable. So that's what the CMHC, Genworth, Canada Guarantee insurance is. Now, in general, I would advise people to put down 5% or 20%. Because when you're looking at the 10% and the 15% down payment mark, the discount that you're gonna get on the CMHC premium or the insurance premium is not enough to offset the additional funds that you need to put down. So if you can qualify to put down 5% and you do not have 20%, which would be optimal because it will save you quite a bit of money, but if you can qualify to put down only the 5% and you're not at the 20% mark, then I would suggest you put down the 5% and invest the difference, or put down the 5% and save the difference in a nest egg for a rainy day. Especially if it's your first home, there's a lot of ancillary costs that come with home ownership, and a lot of people, when they're getting into their first home, they haven't really considered all these factors when they're buying. So they get into a property and they don't have a nest egg, then when things happen, inevitable costs, they're not prepared. So CMHC, Genworth, Canada Guarantee are three insurers. They insure against loss from the bank in case of mortgage default, in case the property, in case you can't pay for your property, your mortgage. The fee is upwards of 3% of the balance. It's added to the purchase price. It's not something you paid, and it's amortized, which means it's divided over the course of the loan. Now, another thing about this fee is it is transferable. So a lot of people may not be aware, if you bought a property and you have this insurance and now you want to go into another like property or something within a certain range, you can take that insurance and you can port it. So for instance, if we bought at $500,000 and we had insurance and we've been there 3 or 4 years, we've accumulated some additional wealth, or maybe we just want to move out of the province or out of the area, and now we're gonna buy a property for $550,000, you've already paid your premium. Now, if you want to go buy another property, you don't want to pay another premium. So they have a program where you can actually port that premium that you paid to another property so you're not paying it again. You know, in this instance, hopefully you've developed enough equity so you're at 20%, so the premium wouldn't come into play anyway. You've gained enough equity. But in the event that you haven't, you are able to port the CMHC and save yourself from some paying additional fees. So that's what the insurance is. 3 major insurers in Canada. That's a bit about how it works. And hopefully when you're looking to purchase, you have enough down to put the 20%, but if not, the 5% rate will be good. It will allow you to get into home ownership.